Welcome to Breaking News to Trading Moves. We always try to take a big headline, one that's getting a lot of attention, and break it down into what it actually means for the market.
And today, we are looking at the details around the reinstatement of Elon Musk's 2018 Tesla compensation plan.
Right. And this was not just some minor legal issue. It has consequences across corporate governance, executive pay, and of course, the EV competitive landscape.
It really does.
So this conversation is really about getting past the noise, the immediate reactions, and focusing on the core facts. What exactly happened? Why does the market care so much? And critically, who are the winners and losers after this all played out?
Okay, let's go over the facts of the decision itself. The key headline here is that Delaware's Supreme Court has reinstated Elon Musk's 2018 compensation plan at Tesla.
And this action, it's important to note, specifically reversed an earlier decision. A lower court had initially thrown the entire package out.
So this is basically the final court clearance on a really complex, long-running dispute.
It is. It provides a finality that has been missing for years. And the scale here, it's just staggering. The deal was originally valued around $56 billion back in 2018.
Give you $6 billion, yeah.
But because of the stock's appreciation and, Tesla hitting all these performance goals, reports now indicate the value is somewhere around $139 billion.
And the entire package is tied directly to those performance milestones.
Right, which they actually hit.
They did. And while the sheer size of the package gets all the attention, what's really noteworthy here is that this compensation was already considered earned. The court ruling essentially just validated the relationship between achieving those goals and getting paid for it.
So for you, the person trying to make sense of this, the so what here is really crucial. This ruling does, I'd say, three specific things for the overall market environment.
Okay, so first, and this is probably the most immediate one for investors, this removes a multi-year cloud of uncertainty that was hanging over the company. A legal overhang, as they call it.
And when an outcome is finally clarified like this, sometimes that matters as much as the actual dollars involved, right?
Absolutely. The removal of this legal risk is a huge point of clarity for investors. They can stop pricing in that worst-case scenario.
And the second thing?
Second, the ruling reinforces how courts might look at shareholder votes and performance outcomes in the future, particularly for these founder-led companies with these huge equity-heavy packages.
So it sends a signal about judicial deference to already earned performance outcomes.
Exactly. And third, this decision lands right in the middle of a larger debate. Many companies incorporate in Delaware because of its legal history.
Right. But this fuels that discussion about where companies should incorporate and how predictable shareholder litigation is.
It really does. It adds a lot of data points to that argument about Delaware versus, say, other states that are trying to be more founder-friendly.
All right, let's get into the market reaction. Let's identify the winners. Our first category of beneficiaries seems to be certain electric vehicle companies. The market often sees legal clarity as a tailwind, and that looks to be the case here.
The rationale is pretty straightforward. This ruling reduces a very high-profile governance and legal uncertainty tied specifically to Tesla's leadership incentives.
And in the market's eyes, that supports confidence in the long-term execution story for that company, and maybe for the broader industry leaders too.
That's it. It allows investors and the company itself to focus purely on execution, not on courtroom drama.
So which companies fall into this category?
Well, the most obvious one is Tesla. That's ticker TSLA. But this sentiment boost also tends to extend to other publicly traded EV companies.
Like who?
Companies like Rivian Automotive, ticker RIVN, and Lucid Group, ticker LCID. It kind of lifts the whole high-growth end of the sector a bit.
Okay, so that makes sense. Now, this next group is a bit different. It shifts away from manufacturing and more into the corporate services sector, specifically the folks who design and advise on executive pay.
This is a really good second-order effect to watch. If the market and corporate boards read this ruling as a validation of these huge, milestone-based, equity-heavy pay plans,
then you'd expect more boards to try and design similar packages.
Exactly. And that increased complexity and focus means companies will have to spend more resources on external support to get it right and make it legally defensible.
What kind of support are we talking about here? It's more than just accounting, I assume.
Oh, much more. We're talking about advisory services focused on design, benchmarking, disclosure documents, and really importantly, intensive shareholder engagement.
Right, getting the big institutional investors on board.
Precisely. The companies positioned here are the big advisory firms. Think Willis Towers Watson, ticker WTW, and also Marsh McLennan, ticker MMC.
Okay. And the final winner group involves the infrastructure that actually facilitates corporate governance itself. The plumbing, so to speak.
Exactly. The ruling, and really the whole discussion around it, highlights just how necessary a meticulous process is in compensation design and shareholder outreach.
So if more companies pursue reapprovals of packages, or they revamp their existing plans, or just intensify their outreach to investors to make sure everyone understands and supports the plan.
That whole process relies on some very specific infrastructure.
So the companies that provide the nuts and bolts for those communication and voting processes would see more activity.
That's right. This category would include a company like Broadridge Financial Solutions, ticker BR, and also Data Storage Corporation, ticker DTC. They're involved in the proxy process, meeting infrastructure, and all those investor communication services. All right, now we have to turn to the other side of the coin, the segments that might be facing some headwinds from this. The first group is the established, traditional automakers who are fighting to convert their businesses to electric.
The logic here being that the ruling, in essence, reinforces the stability of Tesla's management structure.
Right.
So if the market reads this as meaning Musk is going to stay fully locked in and motivated, driving aggressive product development and pricing strategies at Tesla, it suggests the competitive pressure on those traditional players might just intensify.
And that directly impacts these legacy automakers who are already spending billions and billions of dollars just to try and catch up and secure their own market share.
It's a tough position for them to be in. So the companies we're listing in this category are General Motors, ticker GM, and Ford Motor Company, ticker F.
That's right. For them, a more stable, more aggressive competitor is not what they want to see right now. Okay, the second area of potential headwind is governance scrutiny. So while the uncertainty is removed, the just enormous size of the reinstated package brings the whole issue of mega pay right back into the spotlight.
Right. So even though the ruling provides legal clarity, the public debate around these huge pay packages can re-energize shareholder scrutiny, proxy votes, and public pushback.
Exactly. And this is particularly true for companies that are already navigating questions about the optics of their own executive compensation.
So this isn't just a risk for Tesla then?
No, this risk bucket impacts Tesla, again, of course, that's ticker TSLA, as the controversy around the pay package itself is still a talking point for governance watchdogs.
Sure.
But it also affects companies like Meta Platforms, ticker META, which has faced its own shareholder pushback regarding compensation and corporate control structures.
Any company with a powerful founder, really.
Pretty much. And our final category here involves the legal landscape itself, specifically the difficulty for those who want to challenge executive pay in court.
The decision is framed around the idea that it would be inequitable to rescind a package that has now been earned through performance.
Right.
And that legal framing might be viewed as reducing the odds of the most extreme outcomes in similar pay fights in the future.
It could cool the payoff profile for what we call litigation exposure plays. These are financial strategies centered on expecting successful legal challenges to executive compensation.
So if the potential for a huge win in court goes down, the appetite for funding those lawsuits might go down with it.
That's the theory.
And the companies that might be associated with these reduced litigation exposure plays are who?
We're talking about major insurers in this space. Companies like the Hartford Financial Services Group, ticker BUR, and American International Group, ticker AIG.
Okay, so looking forward now.
Yeah.
What does the market watch now that this legal cloud is finally gone?
Well, the immediate focus is on TSLA sentiment. While a legal headline like this can fade pretty quickly from the front page, if this really removes a widely watched governance risk, it could spark some momentum as the company focuses entirely on execution.
And what about beyond just Tesla?
We should definitely expect a heightened discussion around corporate governance practices in general. This includes executive pay structures, the independence of boards of directors,
and the resilience of shareholder reapprovals when they're tested in court? This decision provides a ton of material for analysts and boards all over the world to look at.
It really does. It's a case study. And if we consider all this information in the context of the larger picture, the question for you to think about is this. In this era of high-growth, founder-led companies, how should the market evaluate compensation packages that are structured to reward performance over an entire decade? And what framework best balances shareholder rights with the need to retain, truly indispensable talent?
That's a powerful question to mull over as the market really digests this outcome. Thank you for joining us for this analysis of the market reaction.
And a necessary disclaimer before we go. Please remember that this discussion reflects the opinion of the author and is based purely on the provided source material. is not financial advice, nor is the recommendation to buy or sell any security mentioned, including General Motors, ticker GM, Ford Motor Company, ticker F, Tesla, ticker TSLA, Rivian Automotive, ticker RIVN, Lucid Group, ticker LCID, Willis Towers Watson, ticker WTW, Marsh McLennan, ticker MMC, Broadridge Financial Solutions, ticker BR, Data Stories Corporation, ticker DTC, Meta Platforms, ticker META, the Hartford Financial Services Group, ticker BUR, and American International Group, ticker AIG.